All right. So in today's session, we shall be discussing the types of risk and something related aspects. We all know that in finance, risk is a very important discipline. So it's such a big factor in making and shaping your decisions. Systematic risk is the type of risk which come from the external sources. So it's not the fault of the company that it invites this kind of risk. It comes from outside, totally takes you by surprise. So it just comes from outside. And this risk basically is, we call it systematic because it systematically affects basically all the companies and all the industries and all the sectors. So basically, it's more like a macroeconomic risk, which is not just impacting one firm or one company, but basically it makes an impact on all the industries, companies. As I mentioned, almost entire economy gets affected by it. And you can see that I also wrote some of these, also known as the synonyms. And one of the very important synonym of systematic risk is called macroeconomic risk. So it's such a macroeconomic factor. And it also called market risk because it comes from the market. It's not the company's individual problem. So this risk doesn't arise because your machinery breaks down or your own company's, the managers are not very efficient. It comes from the external sources. Like, for example, if the inflation goes up, if the interest rate rises, if the country's GDP goes down, these are the economic factors. Or if there is a political factors, there is some kind of political unrest in the country, there are some kind of civil war, infighting, demonstrations, there is some kind of, the very, very hostile atmosphere in the country. Or there's an army coup, for example. It has happened in many countries that the democratically elected government is toppled by some military dictator and so on and so forth. It can also come from environmental factors. If there is some tsunami, if there's an earthquake, if there is any kind of cyclones, and that affects the country very badly, so that come from outside. So basically, it could be an economic factor, it could be a political factor, it can also be an environmental factor. So it is not in your control, basically. An individual company cannot control the inflation in the country. Yeah. Of course, it can. It's also a micro unit. It plays an important role. But it has no control over it. So when you have no control over the risk factors, then that risk is called systematic risk. The systematic risk I wrote a word called undiversifiable. Before we understand this word undiversifiable, we should also understand that what is diversifiable. Diversifiable is that many traditional way of people think in a very traditional sense, they also argue that if you invest only in one company, in one stock, you are taking a very big risk. Because if the company stock goes up, you gain tremendously. But if the stock goes down, the value goes down, then you basically lose everything. Okay? So it's very important to understand that if you diversify your wealth in many stocks, then if some of them go down, then the other would go up. So you are able to recover your wealth or at least make a balance. So you're not losing everything out. If you invest in 10 stocks and 2 or 3 are doing very bad, then at least 6 or 7, the remaining, they can save you. So diversification is a very important principle of financial management, but this risk is called undiversifiable risk because diversification will not help you. For example, if you invest in the entire economy, almost every company in the country, and then there is a huge inflation, then all the 100 companies or all the companies which you invested in, they would be equally affected unfavorably. So that it doesn't matter if you invest in one company or you invest in 1,000 companies. It does not matter, because when there is a bad thing happening in the economy, that would affect anyways every company. So your diversification is no longer a refuge from the risk. It's called market risk, it's called business risk, and as I mentioned some time ago, that it's also called macroeconomic risk, because most of the factors which bring this risk are related to the macroeconomic variables like recession. You can see here in the slide, interest rate, recession, inflation, or some political or environmental factors. And it affects almost entire economy, almost all the securities. There's a broad range of securities which get affected. The only way you can save yourself from the systematic risk is through the financial derivatives, the hedging. So you can buy options, you can buy futures, forwards, swaps. So they can save you from this market risk. And we're not covering these topics which I just mentioned, financial derivatives like as I mentioned, forwards, futures, options, swaps. This you will be doing in global financial management, which I hope many of you are doing. It's an online course. So that is something which you study there. I didn't include them because otherwise there'll be lots of repetition. So we move on to the next slide. The unsystematic risk. The unsystematic risk is the risk which is, if I say very plainly and very rudely, this is the risk which a firm faces because of its own fault, because of its own mistake. So this is the risk which affect you, your company, but not the neighboring company. The company next door, for example, when the inflation comes, your neighboring company, and so on and so forth, they all get affected. But when your company's labor are on strike or your machinery breaks down, it's not affecting your next door company at all. So the point I'm trying to make it here is that this is the risk which is only exposed to the company in question, the particular company, but not rest of the industry or rest of the sectors. So this risk is very, if I can say, if you can read those words, AKA, it's a very specific risk. So unsystematic risk is also called specific risk because it arises to a specific company. It doesn't go beyond that specific company. And this is called diversifiable risk as well, because if you invest in one company and that does very bad job, then you are basically losing a lot of money, okay? Because that company is facing that risk, not the other companies are facing it. So if you invest in the other companies also, it means your portfolio is more broad, more diversified. So in that situation, you are able to minimize this risk. So diversification is a very good solution to get rid of the unsystematic risk. It's also called micro risk because it's a very micro unit. A firm is a micro unit, and this risk is only arising to a firm. Hence, this risk is very micro in nature. And it's also called residual risk because you remember last week when we met, and that recording I also, I think it was 17th of September, yeah. And that YouTube video I have recorded and I have sent with you, of course, in discussion forum. You can access on my channel as well, but in that video, you will notice that we were studying Finnair and we were calculating how much total risk Finnair is exposed to. I underline total risk. If from that total risk which Finnair is exposed to, you subtract the systematic risk. I repeat, from the total risk which Finnair is facing, for example, and you subtract the systematic risk, then whatever is left, whatever is remaining, whatever is residual is called unsystematic risk. So first of all, you calculate total risk which a company is exposed to. And I repeat, we have calculated total risk in the context of a real company, Finnair, last week. It's
Hat
available
er
in the
einfach mal
video
reingeschrieben, dass
version.
wir hier sitzen?
And if from that total risk, you are subtracting
Wie sind wir
the
denn? 2, 4,
systematic
6,
risk.
8,
Can
15?
you please mute your... Somebody's speaker is not mute. Okay, thank you. So if from that total risk, you subtract the systematic risk, which I just discussed with you, you subtract it, and then what you get is called unsystematic risk, okay? So we need to be clear about it. And the only solution of systematic risk is the effective diversification, okay? And now I will take you to a spreadsheet. And in that spreadsheet, I will discuss with you that how you are able to split the unsystematic risk from the total risk in order to calculate the unsystematic risk. That's why I use the phrase that the unsystematic risk is called residual risk. All right. So I take you through to the spreadsheet. Any questions? Yes.
There are people in the waiting room, apparently.
I guess wait a sec. Let me check, yeah. All right, so I take you through now. I take you through now to the something. Yeah. So I can show you one spreadsheet, which I hope I can share my screen with you now. And this, yeah. So I want to share my screen once again with you. And I take you to spreadsheet. And I take you to Finnair, for example. Well, any spreadsheet is fine. So if I take you to Finnair risk return comprehensive. So let's see what is this spreadsheet says. Yeah. So I make sure that this screen is getting shared with you. The Finnair, yeah. All right. So now, with the help of this spreadsheet, I want to discuss with you that how to calculate systematic risk and unsystematic risk. So we have the stock return. We have the stocks of Finnair. And these are the closing prices. This is the column that we need to make the calculation. Otherwise, all of the columns are not very relevant. And then we calculate the return of Finnair. This job we did last week also, so I'm repeating. And this comes out to be Finnair's average daily return for the period of 20 years, because I know that there are about 20 years. You can see there's L5037. So there are over 5,000 observations, and on an average in a year, there are 250 trading days. So if 250 are the trading days, and you multiply by 20, so that becomes almost 5,000. So the average daily return of Finnair stock was 0.0247%. And when I annualized it, it comes out to be 9.422, which means that on an average per year, Finnair's stock rises for 9.42%. And this is happening every year for the last 20 years. And then we also calculate the risk which Finnair is exposed to, because without discussing risk, return is meaningless. So the total risk we discussed last week, that the standard deviation, which is a statistical measure, if you open any basic statistics book, you will find what standard deviation is. And we also discussed in the context of some football teams, like which one is more reliable, and so on and so forth. So the standard deviation, so on an average, the average daily stock movement, up and down, fluctuation, variation, is 2.093% on daily basis over a period of 20 years. So for the last 20 years, on daily average, the Finnair stock fluctuate to 2.0993%. And when we make it annualized, then it becomes about 40%. And the same way, we also go to the market return, and the market index which I chose was OMX H Helsinki 25. So I took the index value last week, and then we calculated the return. The return is very simple: the current price, the current value, minus the previous value divided by the previous value. And then the same way, like we calculated the return of Finnair, we calculated the return of the average daily return of the index, return for the last 20 years. And then we make it annualized, the way we did for Finnair. And in the same fashion, we did the calculation of the average daily risk which the index is exposed to, which is 1.354%. And then we also calculated the annual risk, which the index is exposed to. All right, and then we calculated these beta. I think we haven't touched beta yet. I want to discuss with you that beta is a coefficient which is a measure of systematic risk. And you can see here, it says that this is, the beta is also known as, that's a different name, but how we calculate it, it's this. So we use the slope function. So we take the slope, and we take, for example, L2 to L4645 is the Finnair stock return data. And why is L? Because L is the column where we have the Finnair stock return. You can see here that L column is highlighted here. So this is the Finnair stock return, and then we separate it by semicolon, and it comes to be S2 to S4645. So the S column, as you can see highlighted, is the index return column. And once you click OK, it comes to be 0.24. Now, what is 0.24? 0.24 is a measure of systematic risk. Systematic risk which come from the market. So that's why it's also called the market risk. And it basically says, I wrote in the comment as well, that when the market means the OMX H25, when it increases by 1%, the Finnair stock return increases by 0.24%. And when the Finnair, when the index value or the market value, which in this case is OMXH25, when it goes down by 1%, the Finnair stock decreases by 0.24%. So basically, beta shows the sensitivities or the responsiveness of a particular company's stock return to the changes in the index return. Okay, so it shows how sensitive your stock is. 0.24 is not a very highly sensitive value. So beta, any beta less than 1, or let it put this way, the general rule of thumb is that if your beta is more than 1, then the stock is very risky, which Finnair is not. So if you are a risk lover investor, then I don't think Finnair is a good choice for you. So if your beta is about 1, you know, something about 0.95 or 0.9 to, you know, but less than 1, or then you are reckoned as risk neutral investor who can take the calculated risk but not huge risk. But if your beta is somewhat around 0.7 or below, then you are considered as a risk averse investor. Risk averse means those who don't like to take risk, which you can see that Finnair, seeing the beta value 0.24, I can say that Finnair is a choice, is a good choice for those investors who are not very much willing to take risk, who don't like to take risk much. Okay, so they'll rather hate risk. This is for the safe type of investors. The Finnair is for those people. So you can see this decision you make from when you look at beta value. All right, we have total risk, which Finnair is exposed to. Yeah. Well, that's a market risk, but we have the total risk faced by Finnair, which is 40.108. Then, which is here, yeah. Then we have beta 0.24, and then we calculate total systematic risk. And the total systematic risk is calculated by multiplying the standard deviation of the market and beta. So you can see that once I multiply the standard deviation of the market with the beta of Finnair, that would give me the total market risk which Finnair is exposed to. So I can say that this 6.142 is obtained by multiplying 0.24 and 25.872, which is the market's total risk. You know, so when I multiply them both, I get 6.142. It means that this is the total risk, which total systematic risk, which Finnair is facing. And then the unsystematic risk, remember the word I used, the unsystematic risk is called residual risk. Residual risk means from the total risk which Finnair is exposed to, if I subtract the total market risk, what I get is total unsystematic risk. So this is what we get. So the total risk is U13, which is 40.108, which is faced by Finnair. And if I subtract U18, which is total market risk, which Finnair is exposed to, then what is left is the total unsystematic risk. So I can say that out of about 40% risk which Finnair is exposed to, only 6% is coming from outside. About 34% risk is a homegrown risk, which is coming within Finnair. You get my point? So in this task, you not only know how much risk Finnair is exposed to, but you also learn that what is the source of risk. About 6% risk is sourced by the market risk, the systematic risk, the business risk, the macroeconomic risk, all right? And 34% approximately, this much risk is contributed by the unsystematic risk, the firm risk, the specific risk, the unique risk, and residual risk. So I'm using all these names, but for the same thing, so that in case you come across these different words, you shouldn't be confused, right? So this is what we have done today. A very important thing, that for a real company, Finnair, we are able to calculate the total risk which it has exposed to. And you can see that the formula is here, basically. So this is where I have this formula, okay? And from this risk, we are able to take away the market risk, which come from by multiplying beta, which is a measure of sensitivity of a particular company's stock return to the changes in the index return, which means the market return. Index, market are same thing. Index is a measure of the market, basically. And this is what we get. And now whatever is left is basically unsystematic risk. Okay. This risk you cannot reduce by diversification, but because it affects the whole market. Okay. This risk can also be managed by hedging, but this risk you can reduce by not just investing in Finnair, but also in a diversified portfolio. So if you invest only in one company, in this case Finnair, then the element of unsystematic risk will be very high. But as you start diversifying your portfolio, you not only invest in Finnair, but also in the other Finnish companies, not only in Finland, but also abroad. So you have very diverse, international, diversified portfolio, then your total unsystematic risk can go down, and thus you manage your risk. The message I'm trying to give you is that the systematic risk you can only manage by proper risk management policy, and the risk management policy includes some tools, some instruments, and they are some hedging tools like forwards, futures, and so on and so forth, which you study in global financial management course, not this one. And then that whatever is this is called unsystematic risk, and this risk you can manage with the help of what we call as proper diversification. Okay, that's what I have to say about this spreadsheet. And this spreadsheet is, by the way, in your study material folder. And the name of the spreadsheet, if you want to know, what's the name or what is in the name? Yeah, it's Finnair risk return comparison. Finnair risk return comprehensive, sorry, not comparison. The full name of this spreadsheet is Finnair risk return comprehensive, because it's very comprehensive calculations it contains. So this is something which you can have a look from the spreadsheet more in details once you go to Optima and you open the spreadsheets in the study material folders. Okay. Okay. So we discussed the different types of risk and the measurement. And now we have some discussion about the expected return, which we know. But expected return is something which is based on the principle of probability. And the total returns that we get are basically what we expect or what we unexpect. What a description. So, for example, if you expect that you will be, and how you expect it, we will also do in the model soon. maybe in the next lecture, that how we have the expected return. And let's say that you expect that you will be earning 5% by investing in the Finnair stock. And then in reality, you get 7% return. It's more than expected. So out of 7%, the expected return is 5% and the unexpected return would be 2%. So there is element of unexpectedness as well. But if you are expecting 5%, but you end up earning 3%, it means the element of unexpected return is minus 2%. So this is basically the unexpectedness or the abnormality of the returns. The normal is what you expect, and the abnormal element is that if the reality is different from the normality. So therefore, this element, you can see here that the abnormal return are basically equal to R. This R is basically the actual return, the real return, and minus ER, the expected return. So if you expect to get 5% and you get 7%, then your abnormal return is 2%. On the contrary, if your expected return is 5% and the real return is 3%, then the abnormal return is minus 2%, depending upon the situation. This formulation seems complicated, but you will find it very easy once I explain with the help of an example. Let's say that you read some economist journal, some business periodical, Bloomberg, or check at the website, and you expect that the economy, the GNP, will either grow at 1% or 2% or 3%. And there is a 25% chance, the probability, that economy will grow at 1%, but there is another 25% chance based on people's forecast that there would be 3% increase in the GNP. But most of them, the half of the prediction is that the GNP would rise at 2%. So there are different speculations, 1%, 2%, 3%. But the overwhelming, the opinion is that the economy will grow at 50% chance that it will grow at 2%, 25% chance it will grow at 1%, and 25% chance it will grow at 3%. And if the economy is growing at 1%, then your company, not the economy, the company's stock return would be minus 5%. You can see here that if the economy grows at 1%, then the company's stock return, it could be any company, it will grow at minus 5%. If the economy is growing at 2%, the whole economy of the country, then the company in question's stock return will grow up by 15%. And if the economy is growing at 3%, then the company's stock return will increase by 35%. And this is expectation, by the way. And then what we do, we calculate a fourth column, which is the product of situation, the probability, multiply by the expected return. So when I multiply 0.25 with minus 0.05, I get this. So I wrote here, this column is the product of column 2 and column 3. And what we get, when we sum up, when we make the sigma sum, it comes out to be 15%. It means the average expectation, whether it's a 1% increase of economy, 2% increase of GNP, 3% increase of GNP, regardless of that fact, the average expected return is 15%. And if the risk-free premium, if the risk-free return is 5%, which means if the 10-year treasury bond is giving you 5% return, it means you as an investor agree to give money to the government at 5%, but you will be expecting 15% if you want to give it to the company, then the risk premium would be 15 minus 5, 10%. It means that you are placing a risk premium on the face of this company. So basically, you are telling this company that, hey, you know what? If you were the state, I would have agreed to give my money to you at 5% a year. But since you are a private company, hence you are risky, so you have to give me 10% extra risk premium compensation for risk so that I invest in your project. So this is the element of probability in the discussion as well. So when you are when you are calculating the expected return on an individual company's stock, then we normally, keep into account this element of risk premium as well. If any question you have, please ask me. If not, then we move on. And our next point is effect of diversification. In a way, we have discussed it already, effect of diversification. Diversification is based on the notion or the principle that don't keep all eggs in one basket. So basically, don't invest all the money in one or few companies. You should have quite a range of securities, and within each security, you should have a range of so if you, for example, you choose to invest 10% of your wealth in the treasury bond, 30% in the stocks, so 30 plus 10, 40, then another 20% in the real estate, which makes 60. Then you are investing in some commodities, let's say 20%, and then the rest you keep in the bank account, just cash, basically. Then that 30% which you are going to invest in the stocks, even that should be diversified into tech stocks, traditional stocks, then in Finland, abroad, and likewise. So there should be multiple tiers of diversification. So diversification is that you want to make your portfolio as, what's the word for, another word for diversification, as kind of dispersed and as not very uniform type of looking portfolio, okay? Keep in mind that diversification is not just investing in another company. Normally, when we say that diversification, we say that you don't invest in one stock, but you invest in different stocks. Don't get confused that I'm talking about only one company. If you invest all your wealth in Finnair, you are not diversified at all. But if you invest your money in Finnair, in Lufthansa, in KLM, in British Airways, in American Airlines, in SAS, and so on and so forth, you are still not diversified. Even though you have invested in 5, 6, 7 companies, but if you look at them, they all are in the same airline industry. In other words, all the systematic risk, all the macroeconomic risk which Finnair is exposed to, the other companies which I named, KLM, Lufthansa, SAS, British Airways, and some other one, they all are facing the same macroeconomic risk. So even though you are not investing in one company, but 6 companies, but basically the nature of the companies are same, okay? The only thing you have done better by investing in these 5, 6 companies are that you have less of the country risk, because Finnair is only based in Finland, but KLM, Netherlands, France, Lufthansa, Germany, British Airways, and so on. So basically, what you're trying to do is that you are still having the industry risk, but the country risk is now reduced. because you invest in different countries, not in one country. Remember, it's very important to keep in mind that when you are investing in an international company, you're also investing in a different country, basically. So before you invest, you not only check the risk attached to the particular company, but you also see the risk attached to the country. Um, just imagine that there's a country, very high risk country, but the company in that country is really superb. It's a great company. People are, that company is really making a great progress. But when you are investing in the stocks of that company, you are not free from the risk which come from the country where this company is based in. So please keep into mind that the diversification is not just one another stock. You also have to see the nature of the stock as well. Okay? So the diversification for the sake of diversification is not very effective. You need to see the quality of diversification. The quality should be really diverse and very comprehensive. We go on. So diversification is like a risk, like insurance. That if you are, more diversified, then you can lose in one, but you can gain in the other also. All right. So this picture I want to discuss before we finish today's meeting. And this picture is very important. You can see in almost every textbook or any website you open about risk return. And here you can see that on the vertical axis, we measure the risk. And as you can see here, the total risk is measured by the standard deviation. And I hope you know the standard deviation now. Standard deviation is the tool which we applied in the spreadsheets which I discussed with you today and even last week. And standard deviation is a measure of total risk which the company in question is exposed to. And on the horizontal axis or on the x-axis, we take number of stocks from 0 to n, infinity, right? And you can see that the total risk curve is going down. It's convex to the origin, downward sloping. So it means that if you invest in the few stocks, look at the movement of cursor where you can see. If you invest in the few stocks, or maybe one stock, then the risk you are exposed to is enormous, is huge. But as you become more and more diversified, the total risk curve goes down, and eventually at some stage it becomes flat. So if I have to extend this red line, risk line, then if I extend it a bit further, it will be like this, almost parallel to x-axis. Why it's so? Why it doesn't touch all the way to the x-axis? Why it doesn't get zero? The total risk will never become zero because the market risk is never zero. So you can see here that when you are going down, when the risk is shrinking, when the risk is decreasing, basically your unsystematic risk is decreasing, because the systematic risk or the market risk remains there forever. We never have a situation when our market risk is zero. So if the market risk becomes zero, just imagine, for the sake of assumption, if we assume that the market risk would be zero ever, then this curve would touch the x-axis. And then we can say that, yes, the total risk is zero. Because remember, total risk is equal to market risk and the firm risk. So systematic risk and unsystematic risk. Your unsystematic risk can be zero if you diversify your portfolio and you invest in infinite number of stocks. But invest in infinite number of disappear. situation, and then you invest in almost entire economy. Your unsystematic risk can be zero, but the market risk will always be there. If there is a economic collapsation of the country, if there is any political crisis, if there is any environmental crisis, it doesn't matter if you invest in one company or in 1,000 companies, you will lose anyways. Your wealth will be depleted anyways. So therefore, we need to keep in mind that if you know the risk, you should also know how to mitigate it, how to reduce it. And diversification of portfolio is the solution to manage your risk, but that risk is unsystematic risk. You cannot reduce your systematic risk with diversification, because that would be affecting almost entire economy. When the inflation comes, when the interest rate goes up, when the GDP goes down, when there is a kind of some problems in the supply of production, that would be affecting all and sundry in the economy. Okay, so with this, I complete my today's session, and I hope we'll be meeting tomorrow in the physically in the classroom, not like today. So thank you very much for this session.